All right, we're looking at SR Counter Trend 2 on the left, going back to 1987 through 2006, September 5th. September 5th is the date when the markets transitioned from mainly pit to mainly electronic. And so you see the results here. This is with $25 round turn slippage and commission. So very stable to be able to look back at this much history. You can see from about 2001 forward, it's much better. And from about 1996 forward, it's much better. So your average trade profit goes down quite a bit, or would go up quite a bit if you looked at 1996 forward or 2001 forward. But the fact that this strategy doesn't do poorly during this time frame is kind of sideways is always positive. Again, this is with $25 round turn slippage and commission, and SR Counter Trend 2 crude oil, SR Counter Trend 4 crude oil trades much less frequently, and it's also positive as well. Not about half the profit. It uses $25 round turn slippage and commission, and so it's more selective. This strategy is more selective, and this is on pit data from 1987. This is as much history as I have in TradeStation to 2006. It's a day trade strategy. Now, back in the 80s and 90s, I didn't trade until the 90s, but you know, I used to develop swing trade approaches, and so you see smaller average trade profits. The ranges were smaller, and it was less volatile. In a lot of cases, some cases more volatile, but typically you would hold positions a little longer. And here is an example of SR Counter Trend 2. When you simply hold it overnight, you don't exit at the end of the day, and you wait for it to hit its stop loss or profit target. You see the largest losing trade is 1925, and so there are some gaps. In the day trade version, the largest losing trade is 825 because that is the stop loss is 800, and we're using $25 slippage and commission. So I wanted to show you this so you have more confidence in these strategies if you see more history. Now we're going to go to the 2006 forward electronic markets, and you can see what they look like most recently in those time frames. Now this is SR Counter Trend 2 crude oil, and it's going from 2006 to 12/21/2018, and so about 12 years. Here is the equity curve. It made an equity peak on 10/4, and then it's gone down to its worst case drawdown by a little bit, and I want to show you why and why I think it's going to recover. But we're trading this in the 25K portfolio along with SR Counter Trend 4. I want to show you SR Counter Trend 4. Notice that this equity curve is still going up, so they're a good balance for each other. As far as equity curves, you have some diversity in the approaches and the way these equity curves look. These both include slippage and commission. So here's SR Counter Trend 4 from 2006 forward, bigger average trade profit. You know, you get a 64.80 drawdown, so it's a little bigger, but you know, you're getting higher average trade profits than you did back in the pit sessions. And so I want to show you why SR Counter Trend 2 crude oil has gone through this drawdown, what happened on 10/4. And so we're going to look at a daily chart. Here's a daily chart. Here's 10/4. Made an equity peak there, and this market went straight down. Now this is SR Counter Trend, so we like to trade more choppy markets. Trends are okay, but trends this sharp, this is about the sharpest downtrend I've ever seen in crude oil. There are some comparable ones on the charts, and there's ways to measure that, but this is pretty extreme, and I don't anticipate this will continue. On a percentage basis, it could drop again that much on a percentage basis, and you know, we're talking nearly a 40% drop there. So you could drop another 40%, but dollar range, I mean, you're not going to, I don't anticipate we'll drop another $30 here in the next, you know, 8-9 weeks. It'll be down to $15 in crude oil. I mean, anything is possible, but that would be unbelievable if crude oil is at $15. So I think that, you know, you don't want to catch a falling knife, and we're not doing that. But when you look at something like this, you have to assume that at some point this thing is going to be more trendy. Now, if it trends straight up, if there's a sharp trend up, then that would be difficult to trade as well. So that could be the caveat here. If we just go straight up, it may not take any trades if it doesn't pull back intraday, or if there's sharp counter trend rallies down, and when we're taking long trades, it could do the same thing. So that is the one way it could get hurt. But I think it's going to be more choppy now. I don't know that I've ever seen crude oil drop 30 and then rally 30 in a 16-week period. I have to go back and look again, but I like this approach. I like to trade it with the SR CounterTrend, SR CounterTrend 4. And so these are both in the 25K portfolio, SR CounterTrend 2 and SR CounterTrend 4, and we like this setup.